Everyone, welcome to the Edge Computing Investment Landscape panel. It's one of the last panels for the day before our final fireside keynote, and we're pleased to have you here. Edge and IoT are really exciting sectors right now. Based on Crunchbase, there's over 1,000 startup companies receiving funding in the last 12 months to the tune of over $5 billion. Many of these investments were in C to Series D stages, but there have also been several exits, including Siemens' acquisition of Pixium, F5 acquiring Fastly, and View, which is a recently de-SPAC company acquiring Iotium. Your panel today combines expertise from investment banking and leading investors in IoT and Edge. So I'm going to introduce them one by one. I'll read a little bio on them and then allow them to say an additional few words on themselves. I'll start with Joseph Radecki, who's the co-head of TMT Investment Banking at KPMG Corporate Finance. Many of you will recognize KPMG as a leading financial advisory and accounting firm. In their investment banking practice group, KPMG Corporate Finance leverages their combined global access and deep domain expertise to provide growth, M&A, and capital formation counsel to clients ranging from global market leaders to emerging innovators. Joseph has spent 25 years advising clients in the communication technology sector and has, over the past 6 years, become a go-to M&A advisor in the IoT space. Joseph, how'd that sound? Did I get it right?
Well, I appreciate that very much, Darren. Yeah, you did a better job than I could have, most certainly.
Well, welcome.
Thank you.
Next, I'd like to introduce Juan Muldoon. Juan is a partner at Energize Ventures, a firm focused on digital solutions for energy and industry. Juan brings over a decade of experience in financing and investing and is integral to all fund aspects of the fund's operations, including leading sourcing efforts, developing the investment thesis, driving diligence of potential investments, and supporting and monitoring portfolio companies. Juan currently sits on the board for ZEDEDA, our company, Nozomi Networks, Finite State, and Beekeeper, and previously served on the board of Awake Security and Drone Deploy. In addition, Juan is a member of Chicago Blend, an organization dedicated to supporting diversity, equity, and inclusion in venture capital and the entrepreneurship ecosystem. How's that sound, Juan?
That sounds great, yeah.
Well, welcome. And finally, I want to introduce Bilal Zuberi. Bilal is a partner at Lux Capital. Lux Capital is famous for its investments in deep technology, covering areas including 3D printing, machine learning, AI, flying robots, genomics, drones, and more. Bilal is on the board of Desktop Metal and Evolve, which both recently achieved public listings via a SPAC merger, and Nozomi Networks, which recently announced a $100 million Series D, to name a few. Bilal earned his PhD from MIT in physical chemistry. Welcome, Bilal.
Hey, guys. Good to see you all.
All right, so let me set the stage and we can jump into it. So panelists, of course, thank you for being here. We have 40 minutes today. I want to leave some time for audience questions. So to you in the audience, if you have any questions, you'll see a chat window and a Q&A section. Please go ahead and drop your questions directly into that, and I'll ask them as we see them, or I'll ask them at the end. So here's what I'd like to do. I'd like to open up with basically an open-ended question and get each one of you and your views from your fund as we go through this. So I think what I wanted to start with was please go through what you see from your fund's perspective as the market today. And this is specifically as it relates to Edge and IoT. Joseph, if it makes sense, why don't we start with you, then we'll go to Juan and then to Bilal.
Well, I'd be happy to start. Yes, thank you, Darren. And just to be clear, we're not a principal investor, as my co-panelists are. We are an advisor in the space. But from our perspective, we sit in a position that allows us to understand what's driving investment in IoT and what's driving M&A in IoT from both strategic and private equity / venture capital players in the space. We first started dabbling in this space back when it was called M2M and watched the transition around not just the movement of data, but the collection of data and analytics on top of it as it became IoT. What we've seen in the last, call it 18 months, is because of the scale of businesses that have emerged in IoT, a drastically increasing M&A market. We're seeing large strategics stepping in to either fill holes in their technology offering or to accelerate their traction in IoT, we're also seeing private equity begin to play in the space because they can now look at targets with scale, targets that are driving meaningful revenue, or better yet, recurring revenue, and are able to be platforms for private equity. So the interest in the space, I think, has really accelerated, again, last 18, 24 months. And deal volumes, M&A deal volumes tend to reflect that. In terms of kind of what we think is driving that beyond just timing, it's really, we've gotten to a point where ROI is a more identifiable element of how customers are deploying IoT. And in our minds, really what that means is that IoT is driving action. And that action is quantifiable inside organizations. This is no longer about, hey, I can grab a bunch of data off of a thing out there somewhere. It's now about, I can grab relevant data because I've got intelligence at the edge. I can perform analytics at the edge or in the cloud, and I can drive business processes or operational excellence because of the knowledge I'm gaining and the analytics that are driving insights. We think those are big drivers in this environment.
That's great. I can just piggyback off of that. This is actually a really good segue to what I would say. So we cover this from a primarily energy and industrial angle. This is really the place where we play. And for us, the edge is critically important to these sectors for a couple of reasons. Number one, if you think about where these assets are and the huge volumes of data that are being generated by, it could be a wind turbine, it could be an oil rig, it could be a manufacturing plant. These are generally in pretty remote locations where you're touching critical tasks, critical assets, and so latency and security are super important. We see that more and more of the analytics that are driving operational improvement here are moving closer to the source of the data. They're moving closer to the edge. But it's really hard to manage that at any type of scale. And that's really what the industry needs. And so where our thesis really came in was there's a missing link, this missing layer that is needed to really unlock the value of edge for the entire ecosystem. And we think this is exactly where ZEDEDA plays. So we're super excited to have been early investors in the company, and really have seen the ecosystem grow quite rapidly over even just the last couple of years, to what Joseph was saying.
So I'll just add to that. Obviously, majority of the things have been covered. I'll just take a slightly higher level view, which is what we're seeing is a digitization of the physical economy. I mean, this is, you can talk about trillions of dollars of economy we're talking about. Starting in the 1990s, if you think about internet coming in and everything that happened there, the majority of the industries that got transformed were either communication industries, email, media, whatever, or it was e-commerce. To a large extent, the way we bought and used our cars remained the same. The way our utilities operated remained the same. The way our construction systems were handled and managed remained the same. But all of that is at stake now, where all of that is getting rapidly digitized. And I think, as Joseph was saying, availability of ridiculously sophisticated distributed sensors that are now internet connected at a global scale, and allow for machine learning AI technologies, which are effectively large data management technologies and analytics technologies to be deployed across them, enables you to do tons of things that simply were not possible. And I think that is driving a tremendous amount of interest. If you look at those three things, lots of sensors connected digitally via cloud or locally, and having data analytics and machine learning AI capabilities, you either end up with amazing analytics to improve your business processes, or if you close the loop, you end up with automated systems. And I think that's what you're seeing, a lot of automation and a lot of analytics to improve business outcomes. The other thing that has happened is a realization, starting with internet, going to cloud, enterprise broadly, and then now across the board, is that when these companies work, they become really, really big, right? So it is only a few years ago that the word unicorn was invented as the proverbial billion-dollar business. And the idea was that VCs were investing at 20, 30, 40, $50 million valuations as first institutional investor if they hit upon a success, they could get 20x plus 30x returns on their portfolio companies, right? I mean, on a company, if it's $1 billion business. But these days, $1 billion companies sometimes are the starting point of investment for VCs, right? That valuation is where people start investing in some of these companies, some VCs, because the idea is that you can now build $10 billion plus businesses. Of course, the railroads were set on that by the Tesla and the SpaceX, but I can name 20 companies, probably 5 of them in our own portfolio that are on their path to becoming $10 billion businesses, and public markets are approving of that, right? So we're not talking about some crazy irrational behavior by some crazy guys who don't understand technology or who don't understand markets, who don't understand margins and long-term DCF analyses, and they're just pricing these companies up. Public markets going along for it by saying, look, these businesses can grow, and long-term, transformations of these businesses leads to new winners who can become very large. That drives venture capital. That drives venture capital investing in new industries. Juan and I, and I'm sure Joseph is very familiar with, clean tech is not a new word. We were doing this 15 years ago. I was building a company that was a clean tech company starting 2003, 2004. But a lot of those sectors were just early. And, as everything else in internet, as we've learned, there's no bad ideas. It's just bad timing of those ideas. I think we're starting to see that in physical industries as well. Solar was treated as a pariah in 2008 and onwards elections, but now it's growing rapidly across the board. Same thing applies to EVs and then autonomous cars, electric vehicles and autonomous vehicles. The same thing applies to digitization of utilities broadly. Think about manufacturing, 3D printing. There was AM 1.0, now 2.0. So across the board, you're seeing that. And I think when this transformations happen, it's not just the big ideas, it's an entire stack gets created. You have the infrastructure stack, you have all the communication, security, and networking stack, and then you have application layer and many layers of the stack that gets developed there. That unlocks many opportunities for many big, large companies to be created, and that drives entrepreneurs, and VCs just follow them.
So let me ask a question.
I might
Yeah.
layer onto that, Darren, just by pointing out, and Bilal, I don't know if you intended to say when it happens. Frankly, I think we're seeing it start to happen. 4 or 5 years ago, IoT, everybody wanted to be IoT. Everybody changed their company to be IoT, broadened the definition in order to do it. But the customer uptake wasn't there because the solutions couldn't deliver the analytics, the insights, and frankly, the networks couldn't handle the data volumes. And Juan, you mentioned that. We have to be in a position where there is intelligence at the edge because we can't send all that data. All the data that's coming off of that windmill or from the factory floor, we have to be able to make decisions at the point of action about what data is relevant and what data needs to be analyzed real time so that decisions can be made and action can be taken. I think we're knocking on the door. We're seeing deployments, right? We're seeing AT&T announce initiatives in IoT. We're seeing Siemens announcing 5G exercises in IoT in facilities. We've reached a point where the communication link is capable, the RF is certainly there, and the intelligence sitting at the point of action is capable, and therefore the outcomes are being driven. I think that's a really important element of where we are from a timing standpoint.
I agree, and actually, maybe just one more anecdote to that. I think what's most exciting from my standpoint is maybe not to see the Siemens or GE or the big companies making these big announcements or these product releases. It's the mid-market companies. It's the the actual mom and pop manufacturing. It's the not the Fortune 10 but the Fortune 1000 that is starting to adopt this technology because those guys don't mess around. They don't have a lot of patience for hype. They need solutions that actually deliver value. I think they are one of the big leading indicators for where growth in the industry is really coming.
That's a great point, Juan. Yeah, I agree.
So one question I wanted to ask actually goes back a step, but this kind of sets it at the macro level. As we talk about things like more and more unicorns, bigger fundings, funds, even in the session or the period of time before we got on, we were talking about these funds raising larger and larger amounts of capital. So generally speaking, you're kind of seeing this swell of capital going into these companies now. So the bottom line of the question, are we in a bubble? And I'd like for all of you to maybe take a shot at this one. And then how does that impact the IoT edge market, which is a little bit earlier than some of these other sectors that we're seeing being invested upon and exiting now? Joseph, do you want to take that one first and same order? Yeah.
You know what? Again, my perspective is a little different here in terms of how my colleagues are contemplating employing capital. From an M&A advisory perspective, I can tell you that we are seeing very aggressive behavior on the part of both, well, primarily strategic in this space, operating company acquirers, but as well private equity as they continue to dive deeper and deeper into the space. So aggressive buyer behaviors include expanding valuation multiples, more buyer-friendly terms on an acquisition. And in many cases, we're hearing from the large strategics that these are imperatives to them. They have a 5-year strategy, and making these moves now in IoT and edge and analytics is what's going to tee them up to achieve that 5-year strategy. And so, again, we're seeing very aggressive behaviors. Is it a bubble? I think there's a lot of runway. Frankly, I think from a strategic standpoint, we're in the bottom of the second inning in terms of the M&A activity that's going to happen in this space. I just think there's a lot of runway left here. There's so much investment that has to be made in the physical infrastructure to connect the physical to the digital that allows then for the analytics at the edge or in the cloud and the insights to be driven. There's a lot of runway here.
Yeah, I think I agree with you. I think that we are definitely in a hotter environment than what we have seen in the past, that investors, even in the early stage, are having to chase deals, become more reactive, or get really proactive in creative ways to some of the same sort of mechanisms that you described, right? Having to pay higher multiples. It's a very favorable fundraising environment, I think, for CEOs. The other side of that coin is we're seeing a lot of shotgun marriages happening where investors may have to move too quickly because they don't want to lose out on an opportunity. We don't think that's a great sign for the market. And the other side of that is, we see a lot of companies that are still in very early stage, essentially getting full credit for perfect execution of things they can control and some things that they cannot control. Do we think that this is sustainable forever? Probably not forever. I do think there's quite a bit of room to run because, capital is finding a home with better return on equity. And frankly, I think that there's still a lot of opportunities to do that. There's still a bunch of cash on the sidelines, whether you're thinking about institutional investors or even the funds that are starting to be raised now. So I agree with you. I'm very optimistic about ways to deploy capital, but I do think that we have to be smart about it, and we have to make sure that you're not just chasing a hot deal because that's what it feels like a lot of people are doing here.
I'll just bluntly answer your question that if you had asked me this question a few years ago, I would have said probably yes. And I would say, no, I don't think we're in a bubble right now. And for all the reasons that, Juan and Joseph said, but also the size of the pie is we just found by doing it, all of us, that the size of the pie is way bigger than we anticipated it to be, right? Nobody anticipated Tesla to be valued what it is now. Even if it was worth 10% of what it is now, it's still a freaking $60 billion business, right? It's the size of GM. GM is a $73 billion business today. GM bought a company that had, a few cars driving around San Francisco for up to $1 billion. And we all thought that was the craziest thing that anybody's ever done. That company is now about 10 to 25% of the contribution to GM's market cap. And that's Cruise, right? And that was a startup funded by a bunch of crazy guys out of MIT, built by a bunch of crazy guys out of MIT, funded by a bunch of VCs in the autonomous car world, right? So Zoox was bought for $1.4 billion by Amazon, right? And Zoox thinks that it was undersold itself. Joby, which is at $0 in revenue, but the application says it's a $5 billion plus public company, right? So, the combined market cap of newly public 3D printing companies is probably higher than $10-12 billion, right? And we're talking 3D printing, that's it, right? So I think that the market's TAMs are very large. The growth rates are pretty high of all of these companies. Desktop Metal that ended last year at like, I think about 20 million in revenue or something in that range is probably going to end this year at a, greater than 100 million, 150 million in revenue actually, and, maybe $250 million plus revenue run rate. So it's, these are very large markets. And when you're playing into large markets, you own them. Like, there's no reason why the industries that we're talking about, industrial, energy, mobility industries, why should they not have the Amazons, Facebooks, Googles, Netflixes, Stripes of the world? Why should it not be created? Why should we assume that the next big thing in industrial is going to be Rockwell? Why? Why should it be Honeywell? Anduril is now a $4.5 billion prime in the defense industry, right? The next big prime is not Lockheed Martin and not Raytheon. It is going to be somebody that looks like Applied Intuition or Anduril or, and many other companies. So I personally think that for too long, because the only exit opportunity that people had in mind was to be bought by one of the larger players, and those guys were themselves trading on very low multiples, and they bought companies at even lower multiples. That kept everything very collapsed into, hey, maybe Raytheon can buy you for $100 million, or maybe, GE can buy you for $200 million. Well, how much can you invest in a business where the outcome is limited to $200 million outcome? I think over the last 10 years, we've basically broken those shackles. We now believe that these are multi $10 billion businesses that need transformation. You can build independent businesses. You don't have to sell to Siemens. You don't have to sell to Schneider. And I think that is going to create huge opportunities. Many companies will fail, but failure is a part of our business model. But those that will succeed will be big. And I think that's what's driving valuations. That's what's driving money. And to be honest, if all it does is attracts amazing talent to work on industrial transformation, I think we've done an amazing job.
So that leads me to the question, what's the role of the strategic investor then? I mean, you had a really interesting point right now. In the past, startups look to these larger strategics to be acquired, but their multiples, kind of hampered what that acquisition could be for. But they're still important, right? I mean, they provide validation to the company. They can be an initial customer. I don't know who wants to go first on this one, jump ball. But what's the role?
I'll go first because the others are closer to them.
Bilal, before you launch it, I want to, if I could be so bold as to disagree with a point that you made a second ago. I don't think strategics have been hampered by their own valuations. I mean, look at what GM did with Cruise, right? We sold a company to Delphi, now active, called Control Tech, that was well into the double digits of revenue multiple. And Delphi was not selling at a revenue multiple. I think because of the importance of these technologies, large strategic players are not bound by the strictures of their current valuation. I don't disagree that the public markets have opened up a new avenue for exit for investors, but I think strategics are being much more aggressive today, and they're not being held back by their own valuation.
So I actually agree with you, but I think that's the recent history, right? Like when I built a company, there were 4 buyers. Why did we not have an automotive company in 55-year history of American automotive industry since Second World War? Because who the heck is going to buy you? There's no exit. Your lender of last resort is GM, Ford, and Chrysler. But somebody crazy had to come in and tell these guys that if you don't do it, I'll build a business that 10 times your size of the business in terms of market cap. And that's when GM is like, oh, I got to buy Cruise. And Amazon's like, I got to buy Zoox. And, it's not out of, today, the answer to your question, Darren, is that strategics are extremely important, extremely relevant, extremely knowledgeable. Don't get me wrong. Startups don't know how to bend metal. Startups don't know how to produce millions of cars at scale. They just don't know it, right? But they have technology. They see that they can actually play at a global stage. Strategics realize that they have one of 2 options. Either you have the, pardon my French, but the balls to step in early and say, I'm going to acquire a company early, like GM did with Cruise when there was no business model, there was no revenue multiple, it was $0 in revenue, infinite multiple, right? Zoox had no revenue, bought for $1.4 billion, 0 revenue, right? Either you step in and do that, and many companies are like, either their shareholders won't allow them to, or just not ready yet. So they feel like they have to be a part of the story. And that's when they are, they're getting involved early. They're becoming strategic investors. They've learned how to be better strategic investors. They're investing directly large sums of money. Toyota is a multi-$100 million investor in Joby Aviation, right? And they're investing through other entities that they trust, respect, and value. I mean, Juan's fund has strategics that are part of his fund, and there are other funds like that. I think strategics play an extremely important role. And they're not sitting on their asses. They're learning fast, they're moving fast, they're partnering up with companies, and they're putting their best foot forward. It is no longer the innovation guys who are sitting in a corner, who are just like kind of, putzing around with you until you run out of money. Now it is more active, more deliberate, and to be honest, getting themselves ready that when things start to move, they can be, as Joseph was saying, in an aggressive stance, ready to buy these companies.
Yeah, I agree with that, Bilal. I think that they've been super valuable providers of capital, of strategic access, of insights. And many times they'll see the problem or they'll believe in the solution before the rest of the market does, because they see it in their own operations, right? If you are GE or Schneider or whatever, you're operating at scale. You know what edge at scale means, and you're actually probably going to have, that hair on fire problem earlier than others around the market. And so that realization that they can be an important part of the ecosystem, I think, is really, really important. And then the other thing, maybe just to highlight something that you said, it used to be that a lot of the strategics were more defensive about this. The investments that they made, even the acquisitions that they made, were defensive, right? It was, I'm gonna potentially take out this competitor, this one that might be threatening for me down the line. I'm gonna put it in the shelf and get it out of the equation. And I think today we're seeing a lot of companies, industrial or not industrial, that are looking more to what is the acquisition that is going to be accretive to my business, because my business is changing, because my business model is changing, because my customer base is changing, because the technology is changing. Exactly. Yeah. So, and I think that shift is really, really positive for the ecosystem, because number one, it opens avenues for liquidity that we did not have before. But number two, it actually accelerates innovation at a much, much faster clip than we would without that, huge muscle in the room to say, okay, great, let's take this. Let's actually make this, the de facto technology in the industry. Let's actually, make a winner here. So I think it's very, very, honestly, very, very positive development from the strategics in the ecosystem.
Yeah, and I would agree. And I think I would just expand how we are referring to strategics here, because obviously there are some large strategics who have dedicated funds, right?
Yeah.
Think here, Cisco Investments, Intel Capital, right? There are many big technology companies that have dedicated funds, and some of them are landscape investors. I mean, Cisco Systems at any given time has upwards of 100 portfolio companies. Many of those larger entities maintain those independent investment arms, both for the reason Juan pointed out, which is, hey, they want to be front and center. They want to be aggressive. They want to be supportive of something that they already believe in. But they're also doing it, frankly, to keep an ear to the rail, to hear what innovators are doing, to understand directionally what's happening in this space and how do we adjust our tack in order to be headed toward that end game. And then there are many large strategics that don't have necessarily a dedicated fund, but have an active investing capability where they are making very specific targeted investments in applications, technologies, and markets that they already believe in, with an eye toward maybe we want to acquire them at some point, right? The folks that have the bigger funds tend to be more along the lines of let's keep an eye on the landscape and understand what's happening.
Okay, I've got one more question, and I think we're probably going to run a bit against time because we are against the closing fireside. But the question I have is for all of you, but in your different and respective areas. How do you identify the winners when you're looking at these companies? How do you identify what are the characteristics that you think are going to be a winning company versus maybe one that won't be? And maybe Joseph, from your perspective, it'll be something like, how do you, what do you look for to take on a client because you can see success coming from that engagement? Maybe Joseph, why don't you start and we'll go backwards again? Yeah.
Happy to. So listen, I think from our perspective, it's about momentum of the platform. We are at KPMG Corporate Finance. we're a middle market focused advisory firm. Most of our transaction flow happens between kind of 50 and 500. So we're not necessarily the ones out there doing the $5 billion deals. Goldman Sachs is really good at that, and we let them have it. In our space, it's about momentum of the platform. It's about what is their customer uptake, what is the revenue model? Is it SaaS or is it all hardware, one-time sales? But that momentum allows us to package a story around a client that we can then take to large strategics and private equity and say, here's why this is relevant. Here's why this is meaningful in this space. Big logoed customers, constant growth of the business, regular growth of the business. Those are some key elements for us that allow us to dive deeper in a client opportunity.
Taking something that Bilal said earlier, the cyber and physical sort of worlds converging, and the entire IT or OT stack becoming new, right? Being reimagined. I think companies emerge that sort of become a new center of gravity. And that is because of quality, because of product, because of ecosystem, because of market. But there's usually a couple that really just kind of pull the fabric in a little bit more. And those are the ones we want to focus on. Generally, there's the lagging sort of indicator of quality, right? Business model economics that are more sustainable. Growth is a byproduct of that, I think. If you have the right product in the right market with the right team, the sky's the limit. And we coach our companies to really try to own the space that they're playing in, because these are big spaces, but there's going to be, really, really big outcomes for the winners. And so try to suck the air out of the room as much as possible and become the de facto platform for edge orchestration. Why not, right? I think we're on one today.
Nice.
So agree 100% with everything that was said. This is a very hard question to answer because everybody has a hindsight 2020. I'll actually borrow an answer from another investor, and that applies generally, which is invest in the freshmen and the seniors. Okay. And to the extent possible, maybe stay away from the sophomores and juniors. And freshmen are just, they just don't know enough. So they're willing to make crazy bets that others wouldn't. It's the equivalent of Elon Musk saying, I'm going to space. No different than Leland Stanford saying, I'm going to start a university because whatever, I'm going to just start a university, and builds one of the best universities in the world, right? So the freshmen are the Stripes of the world. Freshmen are the Zuckerbergs of the world. Okay, freshmen are the Kyles of the world at cruise automation, and they just don't know enough, and they don't care that the world will tell them that you cannot go up against Rockwell or Schneider or Honeywell or GE or whatever, and they're like, yeah, I don't know, I'm going to do it anyways. Sophomores and juniors are a little bit dangerous because they know just enough to start believing in themselves too much, or they have one formula that worked for them in the past and they try to apply the same formula again and it doesn't work, because every business, every industry, as we know, is different. Seniors are the ones who have the humility of having had a lot of scars on their backs to say, okay, I'm going to win. I'm only going to do this if I can win big. And I'm going to win big by accumulating some of the best resources around me. They go get the best capital. They get the best advisors. They get the best team. They really surround themselves with everything that they've seen fail. Their VP engineering is not a random person, but somebody that they know knows how to build a team that scales, and invest in those kinds of teams.
Awesome. Well, guys, we got about 5 minutes left. I think what I'll do is I'll give everyone maybe a minute or so, minute and a half or so, to just provide some closing thoughts on edge, IoT, investing. Joseph, why don't you go first? And we'll just continue the order that we've been going with.
Thank you. Well, you've been kind enough to let me go first most of the afternoon. So with deference to Bilal and Juan, I'm happy to start here as well. So listen, as I said earlier, I think we are early in the investment cycle in what has become IoT. I think there's a great deal of room for companies to innovate and to deliver unique solutions and become that leading player in the space that doesn't exist today, right? It doesn't have to be Honeywell. It doesn't have to be Siemens. I think those firms will continue to acquire. They've both been very aggressive consolidators of industrial technologies, inclusive of industrial IoT. But I think there's a lot of room for innovation. There's a lot of room for growth here. I think we're early, and from a strategic standpoint, we're going to continue to see large players looking to fill out technology portfolios, capabilities. And we are seeing private equity come into the space now that there's scale, as I said earlier. So we think the M&A market will continue to be strong here. And we continue to be a very active advisor to companies who are considering that exit. So we'll look forward to our role and being helpful in helping the space mature.
Very good.
I think if we are still early in the investing cycle here, we are at a pretty exciting inflection point of the value and the value delivery cycle in Edge, I think. Just a couple of data points to back that up. Initially, when we first looked at sort of Edge investments in 2017, 2018, we could have counted with maybe two hands, the interesting players. We have over 800 attendees for this session today. And I think that just speaks to the ecosystem coming together, to more customers really starting to adopt this technology and deploy it, and to more and more applications that have value, real world value, being ready to be deployed. And I think that's really exciting. I think we've got folks from SUSE, Microsoft, VMware. These are giants in the technology space that are looking at this because it's important to their business. And I think they realize it will be increasingly important if they want to participate in that cyber and physical convergence. So it's a super exciting time to be in the Edge infrastructure world, I think. And we need a lot of help to keep building it. So super excited to keep contributing as much as we can.
So I'll going with the flow here. I mean, look, I'm not a very old guy, but when I started in venture, this did not exist. Okay. All my work was sitting on this computer, typing, working, and internet was a great thing. Today, if it wasn't for this meeting, I wouldn't have touched my laptop. I would do everything on this. Right? The only reason I'm using laptop today is for this 1 hour that I am on this meeting, where I thought a bigger screen and whatever connectivity would be helpful. Otherwise, I'm sitting at a cafe doing this. I'm taking meetings. Everything is happening in our life at the edge. I'm hugely bullish on Edge, and I think people are idiots if they think this is a passing trend or this will be smaller than the cloud. This will be fucking bigger than the cloud, right? It will be huge, and the reason is that cloud will disappear in the background. It's like this uses internet too, but that's not how we think about it. This changed our lives to mobile lives, and I think Edge is going to be the same way. It's going to be everywhere. We talk about machine learning, AI, and computational in the cloud sector. If all of that can be happening at the edge, why would we do it in the cloud, right? And we will. I mean, it's the fact that our mobile worlds have changed our lives is going to be the same thing in the industrial world. Entire stack is going to get created. We're in the very early days of that. People are still trying to figure out the operating systems for this, right? I mean, we're still trying to figure out if Nokia will build the software platform for mobile, or will it be Apple, or will it be Android didn't exist, right? That's the world we are in. But 10 years later, we all had mobile phones. We all had cameras on them. We all had storage on them. We had all connectivity. We all had, this is the world of the edge we're going to be in. 10 years later, when we do this conference, we're going to be like, what a stupid question we got asked. I'm not saying that about Darren, but what a stupid question we got asked, that is edge cool, or is edge interesting, it's just going to be like, it's like somebody saying, is mobile the next big thing, or is it going to be a passing thing, like a little, song player that we put in a corner after a while? We are just at the cutting edge of it. And my God, I'm super excited, because every industry that is right now, all these big, massive companies that Juan mentioned that are instrumenting themselves to be internet connected, very soon they're going to be like, wait, it's not just internet. I need to be mobile. I need to be distributed. I need to make manufacturing plants distributed. I need to go from line manufacturing to cellular manufacturing. All of that is going to change. That's the opportunity that I think excites me and excites entrepreneurs even more than me, right? That's what they see. They're like, oh my God, I see the future. I just need to go build it.
Great. You guys, this was amazing. Thank you so much. I really appreciate your perspectives.